Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on myself for my monthly ramblings. We'll hop to the ramblings in a second, but before we get there, a quick disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true, but particularly true today because, look, I'm rambling. I'll ramble about a ton of stuff. I don't think there's any stocks I own that I'm going to mention. If I do, I'll try to disclose that. But, just please, none of this is investing advice. Please consult a financial advisor, all of that stuff. Do your own work. And remember, I'm the guy who I've told this story before, but I bought my wife some poopery when we moved in together. And for 6 months, I was spraying it in the air because I thought the poopery was like an air freshener. And my wife saw me and eventually was like, "What the hell are you doing?" It's like, "I'm using the poopery before I go to the restroom." She's like, "No, it goes in the toilet." I was wondering why the floors have been so oily for the past 6 months. So I don't even know how to use poopery. So just keep that in mind when you're listening to this whole podcast. Okay. It is November 17th, 2024. This is the monthly ramblings for November, and I wanted to mention that specific date, November 17th, for 3 reasons. First, I went to lunch with a friend of mine yesterday who just got some great baby news. Congratulations. I think he listens to these on and off. He told me he listened to the October ramblings, and he said it a little more aggressive than this, but he said it that I sounded like I had chugged roughly 15 cups of coffee before I did the last ramblings. I can get very excitable. I know I can be difficult to listen to on any type of, improved playback speed. If you set your podcast to 2x, I'd probably come out sounding like a chipmunk, but I'm going to take that to heart. I'm going to try to speak slower and not be so excitable. Second reason I mentioned November 17th, my anniversary was yesterday. 5 years. Happy anniversary, Alicia. I don't know if she listens to these or not. We'll see. We'll see if she's giving me the anniversary present of listening to these. But the third and most important reason for you, the listener, is I'm mentioning this. We're almost 2 weeks post-election day. And, still all anyone's talking about is election day. If you go to CNBC.com for the past 2 weeks, basically it's been, here's what Donald Trump is doing. Here's what the appointments mean. Here's what his election means for the past 2 weeks. So I just wanted to lob in some quick thoughts on election. And look, I put a weekend thoughts on the blog about the election, the weekend after the election. I'll link to that. But, I think the first order effects, right? Russell screams higher the morning after Trump is elected, and it becomes pretty clear that it's going to be a Republican speed. Bitcoin it's gone from probably 65,000 to 90,000. So Bitcoin plus, let's roughly call it plus 30 to 50% since Trump's gotten elected. Private prison stocks, a lot of things that benefit from the GOP have screamed higher. Some solar stocks, some green stuff, some stuff that benefits from the IRS have gone lower. I think that's all first order thinking. I think it's going to be tough. Banks have screamed higher. I think if you're buying a bank today and you say, I think banks are going to do great under Donald Trump, hey, you're probably right. But I think the first order stuff has been played out. If you're buying a bank today, you need to think, I think the banks are going to do better than the market has priced in under Donald Trump for some reason or something like that. So I am really interested in second order thinking on what will benefit from a Trump administration. And, the one I keep circling back to, there is nothing crazy unique or anything in this, but I do think people forget how volatile things were. You put aside COVID, how volatile things were under the Trump administration the first term. He's tweeting at random companies and the stock prices are moving up and down 5% in a day, or a well-established policy that his administration seemingly has been working on for a year is just tossed out the window by virtue of tweet overnight. So I think people are underestimating how volatile a Trump administration is going to be. And I think you probably can see that through some of his appointments. I don't have a specific way to play that or trade that. There's no company. I mean, there are companies that benefit from volatility, but I guess what I'm just saying is, look, I think the next 4 years are going to be really volatile. You can see that in Elon Musk. I think he tweets out he supports someone for Secretary of Treasury because he thinks they're going to shake the system up. When you shake the system up, I think things are volatile. So, what I'm really thinking of are things that are going long, things that benefit from volatility, or being long volatility in one way, shape, or form. I think is really interesting. Being ready to put cash to work when a company gets targeted or tweeted or something, I think is really interesting. The other thing I think is interesting is pharma this week has been hammered on RFK getting nominated for HHS. And look, if he gets in, it's probably not going to be great for COVID manufacturers or something, I guess. But I do wonder if there is something like a lot of the pharma sector, biotech, all this are trading at multi-year lows. I know a lot of packaged goods companies have gotten hit really hard on the nomination. And I think that's the first place where I look and I say, hey, he needs to get approved. He only has 4 years. He's going to be working with an with a agency that is very much against a lot of these proposals. I think there might have been a little bit of a knee-jerk overreaction. But again, this is just me rambling and talking off the cuff. I don't have like deep thoughts or anything there. That's just my initial thing. So that's it on volatility. The other thing I wanted to rant about a little bit is last month I mentioned, definitely on the blog, maybe on the podcast as well, there was this Trump whale. This was the whale on Polymarket who had bet like $50 million on Donald Trump to win the election, right? And if you listened to the press, they would say the polls show it's 50-50, and you need to ignore Polymarket or all these betting sites that say it's 60 or 65% for Donald Trump. You need to ignore them because they're getting skewed by this one whale who is just leaning on this market, right? And now hindsight's 2020. It's completely possible it was a 50-50 election, though I think Donald Trump's margin of victory in both the swing states and the popular vote suggests that the polls were off here, right? So I don't want to like just completely result, but before the election, you would just hear, oh, it's just this guy who, he's a trader. He's got 50 million lying around and he's a Trump mega fan and he's just skewing all these markets, right? That's all you would hear. And I was pretty skeptical. I was pretty skeptical that one man, even in, I don't think Polymarket was as liquid as people would have you believe, but I was pretty skeptical one man could lean on a market for that long, a market that visible. I was skeptical, but, you just kept hearing it. And then Trump wins the election, and he wins it, pretty convincingly. I don't think it's as big a landslide as some people would have you believe, but he's probably going to win the popular vote by about 2%. He wins every swing state. And then he wins, and then you see all this press coming out and saying, hey, the Trump whale, the Trump whale, he had hired his own pollsters, and he had a different view because instead of having his pollsters ask, who are you likely to vote for? He'd have his pollsters ask, who do you think your neighbor's likely to vote for? And he saw a huge skew between the two of those. And that's why he was so confident. He had a different interpretation. He had a reason to believe there was the shy Trump voter. And I just look at that. I'm like, how was the press, a month ago, they were saying, don't believe the betting markets. It's just this one rogue trader. And then the rogue trader who, again, spending $50 million on this, got to be a pretty damn good trader to have $50 million. But you spent $50 million on this, and then he wins. And the press is like, oh, yeah, of course. He had an alternative theory. And it was like, where was that a month before the election? Like, how is this just coming out? Or I'm just really surprised by that. And look, I know a lot of people don't trust the mainstream media. I think they probably deserve a little bit more credit than give for. But when you have all these pollsters, all these supposed experts just dumping on somebody who, these experts have 6-7-figure consulting gigs to go on TV and talk for an hour a day. And you have this one man who's bet $50 million and they're all just dismissing it. And they don't even realize what this guy had, or if they did, it feels like they kind of buried that he had all this information. At least they could have reported he's done his own polling. It's really frustrating to me as somebody who really believes in these betting markets and free markets. And it's really frustrating that the media hasn't gone back and our bad. We were completely dismissing this one great data point that was completely differentiated, but we were just relying on these polls. So just find that very frustrating and want to put it out there. Okay, let's go to the next thing. Last month, I talked about being in the room with good investors and how I find, it's always great to go grab lunch with a friend or two who is also an investor, who's a good investor. That's always going to spark the curiosity a little bit. That's always going to, but when you get like 10 good investors in the room and have them talking ideas and maybe one investor does a pitch, that really just, I find it really gets the mind flowing. It really makes you want to be a better investor, think about ways to improve your process, all that. So I mentioned that last month. I think I should have dove harder into it. And I should have dove harder into it. And listen, one of the analogies I did was in 2008, the Olympic team got together and famously Kobe Bryant, who was, kind of not past his prime, but he was no longer a young up and comer. He was kind of in his early 30s. He was on the downhill decline, but the young upstarts, LeBron James, Shane Wade, they would talk about how they saw how hard Kobe worked and how much time and effort he put into his craft. And that really influenced them and spurred the next generation. And you continue to see that with the Olympics. And I was kind of thinking about that and making loose analogies to being in the room with other investors. But the way I was thinking about it was this: LeBron James has famously said he spends $1 million per year taking care of his body, keeping his body in just absolute prime elite shape. He's 40 and he's still one of the best players of the NBA. It takes a lot of care. Derrick Henry, who is over 30 and might still be the best running back in the NFL, despite, running back in the NFL being a very young man's game. He spends, I think he said, $500,000 per year on his body. And I was kind of thinking, when you get in a room with all these great investors, one of the interesting things to think about and hear them talk about is all the ways they are trying to get a legal edge these days, right? And I was wondering, what do top investors do that kind of mirrors that? Are the top investors across the board, are they spending millions of dollars a year on analytics? Are they spending millions of dollars a year on expert calls? Are there other things in the same way LeBron James spends $1 million per year on his body to stay at the top of his game? Are there data or insights or anything that top investors spend? I don't know the answer. I do think it's interesting when you go, I'll talk to one investor who I think is really sharp, and they are just all over the alt data when it comes to their positions. But they're not doing it maybe they're using it as trade quarters, but they're not using it so much in a way to trade quarters as a way to track their thesis. And, if it's a restaurant stock, they want to track everything and they want to see hey, make sure the restaurants are ramping up kind of towards their target for a long-term purposes, not to trade a quarter on or off, but for long-term purposes, or just that type of stuff. Another way, you get a bunch of investors room and it'll be interesting to hear, are there unique markets, unique corners of the market that they're really focused on? You get 10 in the room and sometimes I'll hear 3 investors at the same time be like, look, and I'm just choosing this kind of throwing a dart at the map. The Swedish market is really interesting right now because of X, Y, and Z reason. I just find that interesting. Anyway, I was just thinking, LeBron James spends $1 million a year on his body. Are there things that investors can do that they're spending time and research on, whether it's expert calls, data to ramp up, or are there specific nooks and crannies? The Euro step in basketball comes 15 years ago, and now every player is doing Euro steps because it's a big advantage on a fast break. Is there that type of thing? Unique corners, unique plays, unique events that people are looking at? Just something I've been thinking about. Okay, last thing I want to rant on. I was talking to a friend this week, and it jumped out to me. And this is investing blind spots, and it's something I think about a lot. So I will use myself as an example. Though I was talking with a friend, and I'll give that story as well. I have an investing blind spot for financial engineering stories, and I think this is pretty common among more mathematical focused value investors, right? A financial engineering story is, hey, this company trades at 10 times free cash flow. I think it should trade at 15 times free cash flow. All of that cash flow is going to go to buying back stock, and the company is going to grow. So you get this great almost double play, right? You get this huge yield. It all comes to buying back stock at a discount. The earnings grow over time. And by the way, they're going to keep their leverage rate constant. So as the earnings grow, they actually increase the nominal amount of debt while keeping their leverage constant. So shareholders enjoy this wonderful trio of you get a great free cash flow yield. The stock is undervalued. As you buy back more stock, unless the stock goes up, it gets more and more undervalued because the remaining shares enjoy a bigger piece of the pie. Earnings are going to grow, leverage is going to go up, so they're going to spin off even more cash flow as they kind of keep that leverage basis. That has been probably my worst investments overall, and I think it's a blind spot for me, right? I see a financial engineering story, and my brain can short circuit in a way that maybe I ignore some risks, was because I say, hey, these insiders, they have a view of what their business is worth. They, know better than me. I'm worried about XYZ, but they're clearly not because they're buying back shares. So, love the financial engineering stories. Or it can create a lot of blind spots for me. So I have had to, like, literally physically over the past few years, when I see a stock that's a financial engineering story, I need to stop myself and I need to research it, maybe not research it harder, but I need to, like, really think about the risks and say, hey, Andrew, are you just excited because this is a financial engineering story, or is this really a company you want to invest in? What risk are you maybe eschewing because you see this financial engineering story? Is it kind of, the same way if you're addicted to something, it lights up pleasure centers and it ignores all of the danger centers? Is the financial engineering story just lighting up your pleasure center to such an extent you're ignoring everything else? So that's one thing I've really had to work on. With my friend, we were talking and we talked about maybe 4 companies, and we mentioned they had some type of existential risk. And he mentioned, look, I evaluated these existential risks, and a lot of people do pre-mortems. If this investment goes wrong, here's the reason it went wrong. He noted these existential risks in his pre-mortem, but thought they were very, very tail risky. And, if we talked about 4 to 5 stocks, 2 to 3 of them had this type of existential risk and came out to play. And I kind of mentioned, hey, it's great you identified them, but if you're identifying these existential risks and giving them very low probabilities, because you can't buy a company with a big existential risk and without it being low probability unless you're getting real, like, kind of skewed returns. And 2 of them came out to play. I think my question to you would be, are you underestimating these existential risks? Are you going and buying companies that have this type of existential risks? And if you're generating alpha, it's because you think you're generating alpha, but actually what you're doing is you're getting paid for taking on this existential risk that is bigger than what you're forecasting. I don't know, but I thought it was interesting. And the reason I mentioned that, I'm thinking about investing in blind spots, always trying to evolve, giving that. But the other thing I was interested in was when we were talking, I was kind of like, look, you've identified these, and it sucks that they've gone against you. But as I was, like, wrapping this up, I was kind of thinking, well, every company does have existential risk, right? Like Berkshire Hathaway, people have to say, oh, this is the greatest. They will be around cockroaches, come rain or shine, post-nuclear war. Probably, but they're a giant reinsurer. You could imagine the Isle of Manhattan falls into the sea. Like, I don't think that's going to be great for giant reinsurers. You could imagine, like, there are just different ways that any investment could break. I was mentioning one to a friend, a different investment, and he said, oh, it's a small cap company, and they basically have 2 major assets, right? Let's say a small cap company, let's say it's an industrial, they've got 2 major manufacturing assets, or, an oil well. That actually is a better one. It's an oil well, and they've got 2 major oil wells. And, one of them is in, let's say, Montana, and one of them is in Florida. And the friend says, oh, okay, well, that's great, but this isn't ExxonMobil. So you're really exposed to sinkhole risk here, right? If the company's worth 100 and you think, and 50's from the Montana assets and 50 from the Florida assets, like, your big risk here is one of these assets falls into a sinkhole, or, obviously in this case, it's oil that goes dry early or something happens. And I was thinking about that, and I was like, yeah, you're absolutely right. But, I was kind of thinking about it, and oil might not have been the best example. Let's use casinos, right? If you're invested in one casino company, you are very much exposed to that casino falling into a sinkhole, the town fire, explosion, all that sort of stuff. Absolutely. But I was kind of thinking about that after, and it's like, look, it's not like there's that many casinos in America. If you invested in Caesars, you would probably be surprised. You're basically exposed to the same sinkhole risk, right? Like, how much of Caesar's value is in Caesar's Palace and 2 or 3 other properties on the Las Vegas Strip? I would suggest it's a lot. So I guess I was just kind of thinking about this. And again, I'm rambling. That's what these November ramblings are for. But it's kind of thinking about this and be like, existential risk. And when people see now there are one product companies that can be exposed very much to distribution risk, but I think people see a company with one casino, one well. Now, one well is probably riskier than one casino. One casino, one well, one manufacturing plant, and they say, "Oh, huge sinkhole risk." And I do kind of suspect you underestimate for a lot of big companies, not all. Obviously, Apple has no sinkhole risk. But there are a lot of very large companies. Tesla, what happens if the Gigafactory is exposed to a sinkhole? I think a lot of people would say Tesla is so large. That's $1 trillion company. They don't really have sinkhole risk. I kind of think they have quite a good deal of sinkhole risk on top of probably key man risk as well. So anyway, that's a lot. It started with financial engineering, went to existential risk. But I do think about those existential risks. And I think on one hand, I don't know. My friend and I discussed the existential risk of the companies that have gone for him against him. I don't know if he over properly estimated them. If, you could say, hey, I'm taking this and there's a 1% chance of it happening, and make the investment 2 times in a row, and the 1% chance comes up both times, right? You don't know, but you can't hindsight it. Now, if you had done it 20 times and 18 of the 20 times the existential risk set up and say, hey, you underestimated. But, I just wanted to mention that existential risk and mention, I do think there are companies that are smaller that have single assets where people say, oh, this has some type of existential sinkhole risk. And I actually think it's probably not that far off of what a lot of larger companies have as a risk. And just to go back to existential risk, I do think that one of the things that happens every cycle in investing is there's a group of managers who come up and have great returns, and they come down. And I do think sometimes what happens is you have a group of investors who they have ridden some type of existential risk without knowing it, and they are getting paid by the market for taking this existential risk on. And as long as it doesn't happen, they get paid very well. And then it happens and it kind of all goes to zero. And, I think about there were a lot of financials investors in the early to mid 2000s who were doing great. The world was their oyster. Nothing could stop them. And then the financial crisis happened and turned out, hey, you weren't this brilliant guy. You were maybe taking on excessive leverage, or you were betting on these products and you didn't realize how much you were getting paid for the zero risk of these products. Or, right now, I think this is a little bit different, but big tech. I have always thought big tech is exposed to some type of government regulation or government pushback risk. And as long as the governments don't use that, I think the big tech companies have and continue to make a fortune and supernormal profits. And these are businesses the likes of which the world has never seen before. But, I look at Google getting sued by the DOJ, or I think just on Friday or Thursday, the FTC announced an investigation into Microsoft. It would not surprise me if it turned out that not all, but part of the reason these big tech companies have done so well is because investors in them have been writing, hey, the government does not crack down on these things at risk. And maybe like 5 years from now, you do get some type of crackdown, and these things generate 10 years of underperformance. And we look and say, oh, like even when these were huge, they were not getting regulated enough, or not getting regulated by the government. I don't know the exact answer, but that's why investors were doing so well in them. And if they start getting a little bit more pushback from the government, maybe things slow down there. Now, you could say, look at Europe. They're already getting regulated pretty well. The government's definitely turning a closer eye to them, but it's one thing to think about. Anyway, I have probably rambled on long enough. The funny thing about these is I write these and I say, oh, I'm not going to be able to talk. And then I start talking, and I also say I'm going to slow down. And then I start talking and my voice gets faster, and I just keep talking and talking and talking until I say, oh gosh, Andrew, what have you done? What have you said? That is it for my November ramblings. I will be back sometime in December for my December ramblings. I am plotting out my vision and how I want my empire to evolve, change everything into 2025. I've got a lot of thoughts on that. But if you have anything, you think, hey, Andrew, the ramblings are the worst thing in the world, get rid of them. I don't know. I think enough people like them, and I like them enough that they're worth time. But, if you said, hey, Andrew, we should only do ramblings, maybe I'll spin off a different podcast feed. Probably not that either. But if you have suggestions, I know one thing a lot of people always want is they want follow-up guests, right? A stock does great or terrible. It was pitched 6 months ago on the podcast. People say, I want follow-up guests. Look, I'd love to do follow-up guests. I could try to do it harder. But the thing is, a stock goes up 2x. I don't know if there's a need to have a guest come back on the podcast and be like, yes, the stock went up 2x, right? Stock goes down 80%. I know people would love to have the person who pitched it come on and talk about it. But the fact is, like, these are serious people. I'm not going to reach out to them and be like, hey, hold yourself to the fire. Come on the podcast, explain yourself. If the person wants to, I'd love to come on and discuss, like, what went wrong? Is it opportunity? Is it risk? Was there something missed? But I can't do that. If you want to reach out to guests, and encourage them. I'd love to have them, but I guess I mentioned that because I know a lot of the advice will be, hey, have guests on for follow-up. Probably, I'm probably doing enough of that, but if there are other advice for the podcast or the blog or anything, Andrew, you read a lot of fantasy books. Start a fantasy book spinoff. I'm down. Let's go. I'm ready. But if there are any other advice, always open to hearing them. All right, rambled enough. I will see you all in December. Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.